Sunday Strategy Digest, the month in review. Updated the 12th of July 2026. Cosmic Algorithm Limited and Backseat Trader. The latest dashboard shows the strategy continuing to compound over the longer term while navigating a more volatile short-term Nasdaq 100 backdrop. The key message is that the process remains systematic when technology and semiconductor leadership reverses sharply. Updated performance snapshot. The latest dashboard shows an annual growth rate since October 2022 of approximately 26.6%, and a cumulative gain since October 2022 of approximately 101.9%. The trade execution dashboard shows an annual growth rate of approximately 25.5%, with net asset value growth of approximately 101.5% since October 2022. Over the selected one-year comparison period, Cosmic Algorithm is shown at approximately 61.06%, compared with 31.13% for the Nasdaq 100. The 2026 monthly performance heatmap records January at plus 6.3%, February at plus 12.7%, March at minus 1.3%, April at minus 4.6%, May at plus 17.5%, June at plus 51.6%, and July at plus 1.6% to date. Recent portfolio pullback. The equity curve has recently pulled back from a fresh high above 105% cumulative gain to approximately 101.9%. That is uncomfortable, but it is not unusual for a momentum strategy concentrated in areas showing the strongest relative strength. The portfolio has had meaningful exposure to semiconductors, memory, storage, artificial intelligence infrastructure, and related technology leadership. Those areas can move together, so gains can reverse sharply before the monthly rotation process has fully refreshed exposure. The key question is therefore not whether volatility appears. It is whether drawdown remains tolerable, whether the model continues to rank objectively, and whether weaker positions are removed as relative strength changes. Nasdaq 100 market context. Recent market news reinforces that interpretation. On the 7th of July, Reuters reported that the Nasdaq fell 1.16% as Micron and other chipmakers were hit by renewed doubts about the durability of the artificial intelligence-driven rally. That followed a sharper semiconductor sell-off in late June, when the Philadelphia Semiconductor Index fell 7.9% as investors questioned debt-funded artificial intelligence spending and a potentially more hawkish interest rate outlook. But the picture is not one-sided. Reuters also reported a rebound in chip stocks on the 6th of July, while the Nasdaq finished the week to the 10th of July up 1.7%. Investor enthusiasm for artificial intelligence infrastructure also remains evident, including the strong Nasdaq debut of SK Hynix. Outlook for the months ahead. The constructive case is that artificial intelligence infrastructure demand, semiconductor earnings, memory demand, and data center investment continued to support selected technology leaders. The risk case is that valuations, crowded positioning, slower artificial intelligence capital spending, higher interest rates, or earnings disappointment trigger further rotation away from the strongest 2026 winners. The next major test is earnings. Reuters has highlighted upcoming results from TSMC and major United States companies as important signals for whether artificial intelligence-related demand remains strong enough to justify current expectations. For this strategy, the practical conclusion is unchanged. Do not forecast. Do not chase. Do not override the model. Continue to rank, rotate, and rebalance according to relative strength and risk behavior. Assets under copy, equity, and adoption. The dashboard records assets under copy rising from approximately $115,843 to $130,640, while equity increased from approximately $18,363 to $22,180. That growth is encouraging, but it should always be read alongside risk and performance. Current example exposure. Current example holdings include Applied Materials, Palo Alto Networks, KLA Corporation, NVIDIA, and Lam Research. These are examples only, not recommendations. Positions may change as the model updates. Key takeaway. The latest dashboard shows a strategy that remains ahead of the Nasdaq 100 over the selected one-year comparison, while also experiencing the inevitable pullbacks that come with concentrated market leadership. The recent decline does not by itself invalidate the process. It reinforces why discipline, diversification, rotation, and risk control matter. Performance should always be read beside risk. The objective remains long-term compounding through a repeatable, rules-based process rather than prediction. Past performance is not indicative of future results. Investing involves risk, including possible loss of capital.